Stocks are on track to finish the week, month, and quarter in the red due to the lasting impact of the pandemic, high inflation, and the Fed's aggressive tightening cycle to curb it all. But WisdomTree senior investment strategy advisor and author of the investment classic Stocks for the Long Run, Jeremy Siegel, maintains that argument even in today's environment. He joins me now with WisdomTree Global Chief Investment Advisor and contributor to the book, Jeremy Schwartz. Professor Siegel, let me start with you here. What grade would you give the Fed here?
A D, barely.
Why is that?
Well, first of all, they're responsible for the inflation by being way too accommodative and way too late in their beginning of the tightening. And then I believe that they're going overboard in the other direction, or at least indicating by their dot plot for 2023 that they're going to become tight for longer, which I think is going to be a big mistake on the other side.
I'm not here to run PR diversion for the Fed, but I guess I would ask, with some of the layered on challenges that they're navigating as well, that they don't have control over, whether that's energy prices, whether that's the supply chain, when do you expect some of that to also be kind of rectified for and ultimately help support at least the Fed policy pathway?
Well, the inflation we have is only very small part supply chain. I mean, supply chain has corrected itself dramatically, and we still have inflation. We have inflation in the background. It was excessive monetary expansion. The money supply has expanded 40% from the pandemic to the present time, which is the greatest in U.S. history. We have never seen expansion of money like this. And listen, inflation is the price of money, and if you supply too much of anything, its price is going to go down, and that is what inflation is.
Jeremy Schwartz, let me go over to you. So next week, new quarter, fourth quarter, but probably a lot of the same negative vibes that we've been dealing with the past 3-6 months. How should one invest?
This is one of the earnings season problems you're going to see. One of the big narratives, and from the professor talking about too tight of a Fed, you got a very strong dollar. Even Nike reported earnings today, and the big hit from the dollar. There's going to be headwinds to U.S. multinationals. People worry about valuations. I think we say valuations have come down, but one of the professor's works, we talked a lot about high dividend investing for this environment, for volatility, for concern that even the big tech stocks still are more expensive than long-term averages. High dividend investing, and that's what WisdomTree does very, very well, I think is core for the long run, but also for the current market environment that we face.
What do you believe of the long-term targets that you've heard companies lay out thus far, Jeremy Schwartz? And when is it actually going to be realized for some of them, too? Because we've heard a lot of this over the course of the earnings season, and it's prompted us to ask our own questions about, for the targets that they're laying out, when investors should expect that to actually turn into realized either profits or just margin returns.
You look at where earnings estimates are, and certainly it was still a good year for earnings. You haven't really seen a big slowdown, earnings being up on the year. Analysts tend to be optimistic and overly optimistic, so you wouldn't be surprised to see estimates come down. Where we think there's some real opportunity is in the small cap section of the market. This is something we also talk about in the 6th edition of Stocks for Long Run. The factors haven't worked. Small cap and value hasn't worked for 15, 16 years. But small cap value today, their stocks are priced for a deeper recession, like a 9 to 10 times earnings across all of our fundamentally weighted small cap ETFs. We have 3 of them for the US market. All are 9 to 10 times earnings. We think that's overly pricing in this recession. People are getting too pessimistic on economic growth. And they're also more insulated from that strong dollar and multinationals and large caps. So we like small caps at WisdomTree, particularly with a dividend bias.
Professor Siegel, last one to you. Are we just now getting a taste of the damage that the Fed might be doing to the economy by raising rates so fast? Look, we might be sitting here 6 months from now, and the 30-year mortgage may be at 10%, and that is going to really hammer the housing market.
Well, I don't think it's getting that high, but it's near 7, and that's hammering the housing market because, first of all, prices aren't going up anymore in housing. We saw that with the Case-Shiller and the national index. So people are wondering about buying at extremely high prices with mortgage rates more than 100% over what it was before. I think you're going to see a much greater slowdown in the housing market. I think you're going to see a slowdown in the economy. And, I certainly hope. I think the short rate will go up more and the Fed will tighten, but it will not tighten as much as the market fears once they see the slowdown in the real economy.
Just to follow up on that, one of the other benchmarks that the Fed is going to be tracking is the unemployment rate. And we've had some calls for that to get upwards of 4%, even upwards of 5%. Where do you believe that is going to come in at, Jeremy Siegel?
Well, first of all, we have to be looking, closely at what we're going to get a week from Friday, what the employment report. It was an interesting article in the Wall Street Journal today about labor hoarding and not a lot of firms, if they see weakness in demand, we'll see labor, instead of hoarding, disgorging, which means we might see a dramatically weaker and even negative payroll reports. I think that will turn the heads of the Fed and saying, whoa, here maybe we should not go as tight. It would be a sorry, to have that happen. But I think that is a possibility toward the end of the year.
WisdomTree's Global Chief Investment Officer, Jeremy Schwartz, and Senior Investment Strategy Advisor, Jeremy Siegel, author of Stocks for the Long Run. Thanks so much for joining us. Appreciate it.
Thanks for having us.